The price of gold reversed yesterday's 1.2% rally versus a stronger US dollar on Wednesday, trading over $100 per troy ounce below last week's fresh all-time high after bullion-backed ETFs shrank yet again and longer-term interest rates rose in the bond market on further Fed warnings about inflation. Global stock markets fell further from this month's new all-time highs on the MSCI World Index, and silver fell 50 cents from Tuesday's high of $32.29, close to last week's new 12-year highs, as industrial metal copper gave back its bounce after losing almost 10% from mid-May's new record high. Trading back down to $2,335 in London's bullion market, gold prices in the precious metals' number one consumer nation China had risen further overnight as the yuan dropped yet again versus other major currencies, offering new imports of gold to Shanghai a premium of $32 per troy ounce, 4 times the historical average incentive. But among Western investment products, giant gold-backed ETF, the Spider Trust yesterday, held unchanged in size after last week marked its first weekly outflows of investor cash in 3 weeks. World number 2 competitor, the iShares Gold ETF, also held at its smallest in almost 2 weeks on Tuesday night, having also shrunk by 1/3 from the COVID crisis peak of late 2020. Reversing all of the pandemic's inflows as a sector, ETF investors now own the same volume of gold as they did in 2019, notes Robert Minter, Director of ETF Strategy at $500 billion UK asset managers Adrian. It is as if pandemic spending, US debt expansion, deglobalization, and structural labor market changes have never happened. Investors are underweight by almost any objective look at the US debt and deficit relative to GDP, currently at levels last seen during World War II. Precious metals as a sector, and in relation to the massive wealth and systematic liquidity generated post-COVID, remains grossly underweight, agrees metals strategist Nikki Shields at Swiss gold refining and finance group MKS PAMP, noting a recent report from Swiss banking giant UBS that says wealthy investors managing their money through family offices currently hold only 1% in bullion. Combining the value of all gold ETFs, most of which trade on Western economy bourses, plus the net bullish value in COMEX futures contracts held by speculative traders, Western positioning in gold accounts for 0.7% of US equities, Shields says, using the Spider S&P 500 ETF trust as a proxy for the value of investment in the world's number one equity market. That allocation has shifted up from its historical floor around plus 0.5%, but remains very underweight versus COVID peak and the bull market era in 2010 to 2012. Gold ETF sentiment may improve once the Federal Reserve starts cutting rates, reckons Mintner at Aberdeen. A rate cut is prudent in June, given the weakness in some areas of the lower-income economy and lingering risks in the commercial real estate market. But many more months of positive II lower inflation data are needed to give me confidence that it's appropriate to dial back, said Minneapolis Fed President Neel Kashkari, a non-voting member of the FOMC until 2026 to CNBC on Tuesday, echoing last week's unison of hawkish Fed comments from other U.S. policymakers. Asked if the Federal Reserve might next raise interest rates in 2024 rather than cut them, "I don't think we should rule anything out at this point," Kashkari added. Fellow hawk and 2024 voter Raphael Bostic of the Atlanta Fed speaks later on Wednesday, as does centrist John Williams, president and CEO of the vital New York operation. Betting that the Fed will cut rates in September, a move predicted for March by the futures market back at the start of this year, today put the odds at worse than 50-50. Fed rates will then end 2024 at 5.07% according to consensus betting today, the highest such forecast since end April, when gold prices briefly dipped through $2,300 per troy ounce. That would require just one rate cut from the Fed before Christmas. contrasting with the 3 rate cuts predicted by the central bank's own policy team in the Fed's March dot plot forecasts, now due for updating at the June meeting in 2 weeks' time. Inflation in Australia quickened in April rather than slowing as analysts forecast, new data said Wednesday, and the cost of living has risen faster than expected in Germany in May, today's first estimate from Destatis said. The Eurozone's largest economy, Germany, has this month seen consumer price inflation of 2.8% on the benchmark harmonized measure, the fastest pace since January. Gold priced in the euro fell back to €2,156 per troy ounce, while the UK gold price in pounds also erased yesterday's rally to trade at £1,835. Friday's inflation data for the 20-nation euro area is expected to show the cost of living rising 2.8% this month from May last year, accelerating 0.1 points from April's 2-year low. That day's US inflation data on the core PCE measure, the Federal Reserve's preferred and target index, aiming for 2.0% per year, is also forecast at 2.8% for April, unchanged from March at the slowest since spring 2021. Please like this video and subscribe to our channel.